All right, cool. So let's see where we're at. So we've gone through the timeline and so forth. Let's have a chat about the income statement. So in terms of the income statement, the top line is obviously the revenue, which is based on an energy yield. The energy yield is, as discussed, related to the energy yield assumption here, the 1300, right? So 1300, which is the unit is kilowatt hour per kilowatt peak per year. So the 1300 multiplied by the 110 megawatts assumption will get us the annual energy production. But then we need to degrade it at 0.6% per annum for the first year and 0.5 thereafter, every year after that. And that would get us the energy yield in kilowatt hours here for 110 megawatt projects. And the tariff, the 4.7116, is basically the tariff that we've calculated here, based on including all the FIT premium that we can get, and then as reducing that FIT by 3% per annum, and that would get us our revenue. Now, in terms of our operating expense would include the land lease, so which is the 450. Which is the 450 NT per hectare per year, an assumption that we have. So for at 100 hectares of land, that would get us the 45 mil NT per year in rental. The O&M fee, which is a percentage of our revenue. The G&A, which is also priced off a percentage of our revenue as well. The panel recycling fee, which we talked about. So for the first 10 years, we need to pay a recycling fee to the government. Replacement of PV modules, but this only happens at the end of year 40. Because our project's only for 20 years, then that's not applicable. And then the inverter, that is replaced at year 11. So we incur a cost at year 11 for that. And then insurance on an ongoing basis, which reduces along with the carrying value of our asset as we depreciate it over the life of the asset. And that gets us our, it's called, Ebitda stands for the earnings before interest, tax, depreciation, and amortization. So this number is just basically our revenue minus our operating expense. As a sanity check, you should look at what is your Ebitda margin. So it's your Ebitda divided by our revenue. It's generally, for solar, is roughly about 80 to 85%. So if you look at this, it's kind of trending around that region. So taking the average, we have an average Ebitda margin of 84%. So this is one way to sanity check that you don't have anything crazy in your assumptions down to Ebitda. Now, we also have the interest, the depreciation amortization. That comes from our depreciation worksheet, which looks at the depreciation for our hard costs as well as our soft costs. Our soft costs would include the financing fees and the development budget. Our hard costs would include our construction costs for the solar power project. And in this case, we're depreciating it at a 15-year straight line. So you can see that every year the depreciation expense is the same. And by the end of year 15, we fully depreciate both assets. So that depreciation expense plus our interest. So the interest comes from our debt schedule. So if you look at our debt schedule, right, we have our debt balance here. So our beginning balance for our debt is from our scenarios manager. So this is how much debt we're raising to cover our project costs. And then every year we repay this loan. We'll talk about the repayment in a bit. So as we repay the loan, the ending balance will take into account that repayment of that loan. So by the end of 17 years, we would have fully repaid the loan. And this is as per the assumption here, whereby our loan tenor is 17 years post-construction. So it means that at the end of 17 years, operations, we would have fully repaid our loan. So the interest expense is the interest rate. So this is the interest rate that we have, right? The 2.75% interest rate, which is the 1.25 base rate plus the 150 margin, the 2.75. So it's 2.75% every year per annum multiplied by the beginning balance of our loan. So this is how much interest we're incurring every year. As you can see, as we pay down the loan, the interest expense goes down every year because the outstanding loan amount is getting lower and lower. And then that feeds into our earnings before tax, right? So our earnings before tax is our Ebitda minus our interest payment minus our D&A, depreciation expense, to get our earnings before tax. And then we have our corporate tax. Now our corporate tax is calculated down here. So we have our profit before tax, which is up here. So this was the same calculation we had just now. So Ebitda minus interest payment minus D&A, right? So this is our profit before tax. We need to, for tax purposes, we need to add back our accounting depreciation and then subtract our tax depreciation instead, because there are two different treatments. So for accounting purposes, the accounting GAAP standard has a set of rules for how you depreciate your asset. And then with the Taiwan Tax Authority, you have a different set of rules on how you depreciate your asset. And then that gets you your taxable income to report to the Taiwan Tax Authority. As you can see, in the initial years, we're making a loss, right? We're not actually making a profit. So which means that the government will allow you to carry forward those tax losses, which is what this is. So to the extent that we're making a loss, it's being stored away in our carry forward tax loss account. In a subsequent year, when we are making a profit, then we would have that profit being deducted from our carry forward tax losses until we've fully used these tax credits. So once we've fully used this tax credit in year 9, that's when we actually start paying taxes during this period, right? So you can see that the taxable income subtract whatever's remaining of our tax losses. The residual income is what is taxable, and this is what feeds our cash tax line over here. So the corporate taxes line here is the actual tax that we pay to the Taiwan government, right? So in terms of the cash flow that's payable to investors, then it's basically our Ebitda, earnings before interest, tax, and depreciation and amortization. The reason why it's before D&A, it's because D&A, depreciation expense, it's not a cash expense, it's just an accounting expense. Similarly, like when you buy a laptop and you use the laptop for the next 10 years, and your company depreciates that laptop over 10 years, that depreciation expense is just an accounting expense. It's not like you're paying out a cash for that expense every year. So as a result, when we look at cash that's available to pay as dividend to investors, we always look at it on an Ebitda basis before D&A. We obviously need to subtract what we pay to the lenders, which is our interest payment and the loan repayment. And we subtract what we need to pay to the government, which is the taxes. And that gets us our free cash flow to investors, which is what's used to measure our equity returns. So this is how much money is actually available for paying to our investors to our shareholders every year, right? So that's the income statement line. So it's actually pretty straightforward. Okay, so the next one is to talk about this, the total project cost calculation. Okay, so in terms of this one, typically in these these kind of like high level evaluation models, we make a bunch of general assumptions in the model, right? So for example, in terms of our expenses, right? So we've got our construction interest expense in this calculation here. What we're doing here is we're looking at the interest cost for the loan, multiplied by the loan amount, multiplied by the number of days during the construction period, which is up all the way up here, D146-145, which is subtracted, so the commercial operation date, the day we complete construction, and the financial close date, which is the day we start construction. So the number of days between 2024 and 2025 divided by 365 days. It's a very generic assumption. It basically implies that we're borrowing all of the loan from day one upon construction completion, but that is rarely the case. So this is a very conservative, simple assumption to make. And then so basically that plus the development fee, and the development fee is basically the from the DevEx budget, and then plus our EPC costs, which is based off the assumptions we've made here in the EPC cost assumption on a per kilowatt basis, multiplied by the number of kilowatts to get the EPC cost, right? That gets us our total project cost. Now, how do we actually fund this this total project cost of $217 million US? Well, we have a LTV assumption here, this 82.5%, right? So we're basically saying multiply 82.5% by the total project cost in order to get the debt amount that we raised, right? So if you look at the formula, it's 82.5, which is up here. Which is the the 82.5 here. Scenarios F133. Oh, okay, so it's actually from here. So this is the total project funding multiplied by the gearing, the 82.5, right? One thing is as you can see from this calculation though, it's looking at the total this number here. If you see this number here, it's looking at all the DevEx budget plus the construction costs, but it's excluding the financing costs. The reason is because it creates a circular reference. So let me just try to explain that a little bit better. Where's the writing for that? Yeah, circular reference. Okay, so right now, in our analysis, we're assuming that the debt size is our gearing assumption, so 82.5%, multiplied by the total costs, which is EPC costs plus our DevEx, but it excludes the financing costs. The reason for this is because the financing cost is based on the debt size assumption, right? So for example, the upfront fee is 1.5% times the debt size. So if we have the debt size being the gearing assumption multiplied by everything plus the financing cost, this creates a circular reference in the model, which is what we're trying to avoid, right? So as a result, the simplifying assumption here is that the debt financing is the gearing multiplied by the project cost excluding the financing cost. Now, what happens if we change the cell reference from the project cost excluding financing to the project cost including financing? What happens is we get a circular reference, right? And it's because of this relationship that our bank fee is driven off our debt amount, which is then driven by the total project cost, because it's 82% of the total project cost, and the total project cost is in return driven including the bank fees. So there's a circular reference here, which you can see here graphically, right? So this is a major no-no, right? So this is a big problem, right? And one of the reasons why it's so you do not want this to happen in your model, right? It's because it makes it unstable. So for example, if you go to scenario cell 143, so yeah, let's say over here we're making a mistake and we actually multiply by ABZ or ABD or something, right? Wait one sec. So let's see what happens. Oh wait, sorry. Hang on a second. So let's go to so let's say you have to turn, okay, so we have circular reference right now. So let's turn the circular iterative calculation stuff on. Right? Yeah, let me just do that again. Okay, so let me just repeat that one more time. Okay, so like I was saying, right now our debt is excluding the financing costs in the formula. If we change it such that it's including the financing costs, right? We have a circular reference. Sorry, one second. Right, so we have a circular reference. Now, let's say if we want to have this circular reference in the model. So let's go here and turn the iterative calculation on, right? It will still get you the answer that you want, right? But it's very, very unstable. So for example, let's say in our bank fees, we make a modeling error and we actually multiply by some gibberish, right? A sec, maybe too much gibberish. Okay, so we have a hash name error, and this hash name error is basically all over our analysis now, right? Everything is gibberish, right? Everything's gibberish. You see all this, right? So everything's screwed up. Now, let's say if you go back and you say, oh, this is where I made my mistake. I shouldn't have multiplied by some gibberish number here. So let me just get rid of that, and it should be happy days. Everything is fixed. But no, still the same problem. You see that? So circular references make financial models highly unstable, which is why we never ever build circular references into the financial model. Okay. And so the only way you can get rid of these errors now, and like I said, it's all over your model. You're probably panicking in the middle of the night, right? Like you have to break the circular reference, right? The only way to do that is to move that back to being a percentage of the project cost excluding financing, right? So now your all the errors are gone. But anyway, you shouldn't even put yourself in this position to begin with. And the only way you do that is to make sure that you design your model such that there are no circular references. Alrighty. So that's one of the key reasons. And the other key reason is that goal-seek doesn't work either. So yeah, so it's a very problematic problem. So just avoid it altogether. Okay. So that's circular references explained. So the only way we could do to fix that is by setting the debt amount to the project cost excluding the financing costs. But we'll be fixing that issue a little bit later on as well. So that's a circular issue. Let's go back. Let's see. Yeah, so let's talk about sources and uses table. So a very good way of summarizing your project is to work out how much money you're raising and how much money you're spending and what are you spending it on, right? So in this scenario, we're raising 171 million of debt, equity of 46 mil, which is a 79% gearing, right? So 79% of our total funds raised is debt. We've got our EPC costs, our EPC contingency costs, our upfront debt fee, our interest during construction, our financing costs during construction, and then our development expenditure of 30 mil. So you should always include this in your financial model as a very clean snapshot of how much money you're spending up to construction completion. Another useful benchmark is to look at your total project cost on a per kilowatt basis. So the all-in cost of getting your project developed and constructed divided by the number of megawatts that you're building gets you a number. Generally, the total project cost on a per kilowatt basis in US dollars should be roughly about 2,000 US dollars. And then likewise, for in NTD, it should be roughly about 60,000 NT. So this is another way of sanity checking your financial model to make sure that you're not producing crazy numbers in, in your financial model. So that's the sources and uses. Let's talk about data tables. So at the bottom here, you see that there's a bunch of data tables in here. So the way data tables work is that you want to see what is the output of the model, whether it's project returns or equity returns, based on flexing an assumption, whether it's EPC cost or whether it's construction contingency, for example, in this case. And then you basically want to say, okay, if my EPC cost goes up from 45, which is my base case right now, to 46, what happens to my returns, right? So just to clear this out. So the way this works is a couple of things. The data table that you put here, the assumptions that you want to flex, it has to be in the same worksheet, right? So these assumptions are actually up here. So if you look in the so if you look at the EPC cost, it's over here, right? And the contingency assumption is also here, just a bit below it. Contingency is 1%, right? So it needs to be in the same worksheet. And then basically, so let me just give you a specific example. Let's say, for example, that you have these 3 scenarios over here, right? So let's say if you want to do a data table showing the project returns and the equity returns. So the project return is here, the 4.86%. The equity return is here, the 10.7%, right? So let's say you want to flex. Let's say for you want to do a snapshot using data tables as to what the returns look like under case 1, case 2, case 3. So what you do is you select the entire data table you want to do, and then you go Alt D for data, T for table, and the row input cell is this cell here. This is the cell that drives which scenario you want to choose. So this is the scenario. And you're trying to make the model go output the model returns based on scenarios 1, 2, and 3, right? So if you do that, you press F9. Wait a second. So you can let the data table down here kind of shows you the wait 1 sec. Is there still a circular reference in here? No, it's done. I think I'm going to shut down one of the other models. Shut this one down. Let's see. Okay, let's try a little time. Yeah, okay, great. So it's working now. So you can see here that it simultaneously outputs the results for scenarios 1, 2, and 3. So the way to check that is, for example, in scenario 2, you can see that the results is 6.3 and 12.7, which is what's showing under scenario 2. If you change this to a 3, it's 4.9 and 20.8, right? 4.9 and 20.8. And that is the same output under scenario 3 over here. So that's the beauty of data tables, in that you're able to output results for multiple scenarios all at the same time, right? And it's also a great way of sanity checking your outputs. So for example, when you set up a data table flexing EPC cost and contingency, you know that intuitively, if your EPC cost goes up, it means you're spending more money. So your project returns should go down. So that's exactly what happens, right? Likewise, if your O&M cost goes up, your returns should go down as well, right? So the data tables is a good way to sanity check to make sure that as you change your assumptions, the results make sense. So if it doesn't make sense, it means that you're modeling that assumption incorrectly. The downside of data tables is that it could be a real pain in the ass. So let me give you an example. So in the calculation options, there is actually two options. One is called automatic. The other one is automatic except for data tables. If you click on automatic without the first option, every time you make some edits, it's really slow because it's trying to update every single data table that you have while you're making every single edit. So it really slows down the model, right? So the best way around this is to make sure that if you're running a lot of data tables, is to make sure that you set it to the second option, automatic except for data tables, right? Because when you do that, then then you can make edits without the data tables updating, so it doesn't slow you down as you work the tables, as you make edits to the financial model. All right, so make sure always that one is set to this one. Yeah. Likewise, when you save, sometimes when you save, it also updates the data tables, and that could take a long time. You can actually bypass all of that by just forcing it to save. So let me give you an example of that. So let's say it's that plus 1,000. So let's say you're trying to save. Oh, okay. Okay, never mind. But sometimes you can just force you can force the model to save without updating all the data tables to save you time as well. So that's data tables. Let's see what else. Okay, so timeline MOIC calculations. So as in a development game, one of the key things that we focus on is the money that we're betting versus the money that we're making. So under the timeline worksheet, right? So as we discussed just now, one of the key milestones for de-risking the project is the SI approval. The second milestone is getting the establishment permit. The third milestone is getting the land conversion, right? So those are really the three key milestones. And for this kind of project, actually the land conversion milestone is the most important milestone. This is the toughest one to get, right? So as a result, what we want to do is we want to know, prior to us getting the SI approval, which is in August, how much money have I spent up to that point, right? So up to August, I spent 9.6 million bucks, right? And then upon me getting the SI approval, I'll need to make a bunch of make a payment to the permitting consultant as a milestone fee. So when he achieves SI approval for me, I need to pay him 3 million bucks. And then also I need to start acquiring the substation land. Until I've achieved the SI approval, I wouldn't have to incur these costs, right? So the amount of money that I'm risking to try and get to SI approval is 9.6 million bucks. So that's my that's the debt exit risk prior to SI approval. Now, the other thing we look at as well is, upon getting my SI approval, how much can I make if I sold the project at that point in time, right? And what we do here is we look at we apply a discount rate of 11%. Now this is kind of like a judgment call, right? Because as you can see, as you achieve more and more of the milestones, the returns go down because the risk have decreased, right? So for projects in Taiwan, where the project has already completed construction, so there's no more construction risk, no more development risk, buyers in the market is willing to buy the project from you at a 6% return. In terms of construction risk, construction is actually relatively straightforward for solar plants as compared to offshore wind or onshore wind or coal or gas-fired power plants. There is just a lot less things that can go wrong in constructing a solar plant. It's just so much more simpler. So as a result, in order to absorb the construction risk, a buyer would need an extra 1.5% return to take on the construction risk. So which means that the equity, if we sold the project at NTP, it would be at a 7.5% return that the incoming buyer wants to buy at. Obviously, the higher the return that you're asking for, the less money they will pay us for the project. Right. So as you know, because you're basically doing an NPV, you're basically doing a net present value of the future cash flows of the project for the next 20 years. Right. So as you know, when you do an NPV, if the discount rate is higher, the lower your NPV value is. Right. So the higher the return they set for the acquisition, the lower the acquisition value is. So this is a bit of a judgment call, but as you can see, once we achieve land conversion, we're at 8%, because once you've achieved land conversion, the rest, there is no more risk, high risk milestones that permitting approvals that you need to get. So as a result, there's a big drop from getting EP to land conversion. It's a big 2% drop here. So yeah, so basically at land conversion, we have spent $15.2 million over here, right? So land conversion happens in September. So we would have spent about $50 million up to get to the land conversion. Now, upon land conversion, if we hypothetically sell the project at that point in time, the incoming buyer would still need to spend all this money, the remaining, all of this money here. So the remaining $13.5 million, right? So they buy the project from us. We've already spent all this money to here, but in order for them to get this project to construction and commencement, to NTP, they still need to spend all of this money, right? And then plus they also need to put in equity to fund the construction, right? So this this calculation encapsulates all of that, right? So it's looking at the NPV of at an 8% discount rate for all of the future dividends that they can receive, right? And then subtracting the D60 minus D70. D60 is the total equity that needs to be invested up to COD. So all the funding that the share that we as the shareholder we need to fund, but then we subtract how much money has already been spent, the 15.2. Right, so equity needs to spend 15.2 to get to land conversion, plus another, yeah, that's right, and then plus another 12.4 in order to get to the COD, right? So in theory, then it means that if we spend $15 million to get to land conversion, and we sell the project to a third party at an 8% discount rate, they would pay us $41 million for it. It means that for every dollar that we invested, we made a $2.70 return. So this is called a multiple on invested capital. So this is a number that we pay very, very close attention to in the development game, right? Especially for the initial permits, because it's higher risk at that point in time. We want to make sure that for every dollar that we're investing, we're getting a decent return for taking that risk. So for the initial milestones, we generally try and target at least a 2 times return on our money, ideally 3 times or more. So this is one important analysis that we do as part of our overall project financial analysis, to make sure that we're not spending too much money up front when we're still trying to de-risk the project in terms of getting the milestones. So that's the MOIC analysis. And then let's have a look at the cash flow waterfall chart. This is something that I always find very useful including in the financial model. This is the project cash flow chart, right? This shows you where the money is being spent on, right? So the this outline here, the envelope of this chart, is the revenue for the project, right? So the FIT price that we're getting for 20 years is fixed, but the energy production is decreasing by 0.5% every year. So which means that our revenue over the life of the project is actually degrading over time, right? Actually, let me go to this one instead. Yeah, it's much better. So, yeah, so the envelope of this project is basically the revenue generated by the project. Now, the money that's coming in through revenue, where is it being spent on? The light blue one here, this is our land lease, right? So our land lease is constant every year because the rental rate doesn't change over 20 years. And then we have our O&M costs, which is the orange. The yellow is our insurance, which is a very tiny sliver. And then we've got our replacement inverter. So in year 11, in 2035, we need to replace all the inverters. So that's that cost over there. And then this is our taxes over here. As you can see, we pay very low taxes initially because we have a lot of interest expense. This is our interest expense line. So as you can see, our interest expense at the beginning is very high because we owe a lot of money. But as we pay down that loan, by the end of 2017, our interest expense becomes zero because we fully repaid our loan by that time. The blue section is the repayment of the debt, right? So basically, once we've fully repaid the interest, we no longer have any interest deductions in our taxes. So our taxes go up after we've paid off our interest. And the green bit here is the FCFE, the free cash flow to equity. This is the dividends that's paid out to our investors. So as you can see, once we've fully repaid our debt financing, they get a lot of dividends in the back end. So I highly recommend recreating this chart in the models you build because it gives you a graphical snapshot as to where the money is being spent on. And as you can see, this is linked through to these calculations over here. And this is basically just looking at the spending for each category over the next 20 years. And this uses a summing function to be able to calculate the to basically find the outgoings for every category of expenses for the next 20 years. So this is a very clean way of showing you what's going on in the project.
Sorry, Ken. I think we cannot see what you were doing before. I think your screen froze.
Oh, right. Oh, great. Oh, geez. Sorry. Actually, I just realized I paused the share screen function. Oh, geez. Okay, so that means a lot of people didn't quite get what I was talking about just now. Okay, never mind. Let me just quickly repeat again. So under the timeline, wait, let me just backtrack a little bit. Apologies, everyone. I didn't realize I paused my share screen. I think maybe, yeah, so the sources and uses table, I think was where we kind of got up to just now. Actually, let's backtrack a little bit more. Let's talk about the total project cost calculation. Yeah, so let's talk about this, the total project cost calculation, right? So in terms of the total project cost calculation, as we discussed just now, the debt financing is basically our gearing, which is a percentage multiplied by 82.5%, right? Multiplied by the total project cost. But we're trying to avoid a model circularity in the financial model right now. So the total project cost we assume excludes the financing costs, right? So it's basically our DevEx and our construction costs, but it's purposely excluding our financing costs to get to our debt and basically the gearing multiplied by that gets you the debt financing assumption. Now, if we, like I said, if we change it such that we link it to our total project cost, which includes our financing costs, that creates a circular reference like this. So it comes up with a circular reference error. We never ever want this to happen. And you know, this is the model points out where the circular reference is, right? Because your debt financing is dependent on your total project costs, which includes all of your financing costs, which includes your upfront fee, and your upfront fee is dependent on how much debt you've raised. So that creates a circular reference in the financial model. Now, if we turn on iterative calculation and get rid of it, it's gone. but it's still highly recommended not to do this because, for example, let's say over here you make a bit of a mistake, right? And you create an error in the financial model, and the entire model is screwed up. And let's say you go back and check your model and you've discovered that you made an error here and you got rid of it. You corrected your error. You think that the financial model would be fixed, but it's not. It's still causing these hash name errors, right? Well, sometimes it does, sometimes it doesn't. But anyway, the best way to design the model is to avoid any sort of circular references. So which is why you should always link it. To break the circular reference for this particular case, we multiplied the gearing by the total project cost excluding the financing. So then it avoids the circular reference. Yeah, so that is the circular reference bit in this part here that we were talking about. Now, in terms of the timeline MOIC calculation. So in terms of the timeline, right? So as we discussed just now, the key permitting milestones is SIA, EP, and land conversion. So one of the things we look at is how much money we've actually spent prior to getting these permits. So for example, on the initial permit, we would want, let's go back to scenario 1. So for the initial permit, let's say, for example, based on our calculations, we're spending $9.6 million to get to SI approval, which is the $9.7 million here. And then we need to work out how much we can actually sell the project for at that point in time. So hypothetically, if an investor is willing to pay you an 11% discount rate on the valuation for the project, it would mean that you can sell it for $12 million. And the way that works, it's an NPV function, which looks at all the future dividends that's payable for the next 20 years, and you discount that back at 11%. So obviously, the higher the discount rate, the lower the valuation is going to be. And then you also need to take into account the remaining equity that needs to be invested. So in this case, we need to invest $43 million to get the project to construction completion. So far, to get to SI approval, we've only spent 9.7. So the incoming buyer would still need to spend the remaining $33 million, the difference, right? So if you look at this, this is the $34 million that they still need to spend. So that's a straight deduction from the valuation. And these returns, as you get more of the permits and the risk of the project decreases, the discount rate that they would charge to buy the project from you also decreases. So that's what these rates are. And as I was saying, this is something that we really focus on, and we generally want to make sure that our money multiple or our multiple invested capital is at least 2 times initially, because we're taking more risks at the beginning. So we want to at least double our money on investing that capital to de-risk that at the initial stages. Okay, so we talked about that. Let's talk about the the data tables that I was referring to just now. The data tables. So the data tables basically simultaneously outputs the model output under different scenarios, right? So for example, if you increase your EPC costs, what happens to your returns, right? So, if your cost goes up, your returns should go down. So that's what this is showing. But a data table basically shows you the all of the different scenarios simultaneously, and it does that by updating all the scenarios simultaneously in the model through the data table tool. And this is a great way to sanity check to make sure that your model is working correctly. So for example, if your EPC goes up, but your returns also go up, then you know that your calculations for calculating your EPC cost is incorrect. So you need to go into the model and see what's going on there. So these data tables is a great way to sanity check to make sure that your model is working correctly. Now, so for example, let's say we want to create what are the returns under each scenario, 1, 2, and 3 here. So then what we do is you put the outputs that you want to display in the data table here, right? So let's say we want to do the project returns and the equity returns. And then we basically select the entire table. We go Alt-D for data, T for tables. And the row input cell, which is the 1, 2, and 3, we link it through to this hard-coded cell, because this cell here is what's driving the entire model, right? So it's a hard-coded assumption. So you press OK, press F9. Yeah, so it updates for under each of these scenarios what the returns are, whether it's project or equity IR. So that's how the data table works. So it's a great way to simultaneously do multiple scenarios at the same time, and also to do a sanity check to make sure that the outputs match the inputs in terms of changes in assumptions. So as discussed, like when you run data tables, always make sure that you're selecting the second option, automatic accept with data tables. Right. The reason is because as you kind of make changes to the model, right, when you select the second option, it updates almost simultaneously. But if you select the first option, which is automatic without the accept for data tables, when you try and make edits to the model, it tries to update every single data table every time you make a change. So that's going to really slow down your editing of the model. So right, so you can see that. So it won't give me the output results until it's updated every single data table. So it really slows down the process. Whereas if you select the second option, this one here, you can update without it forcing the data tables to update as well. So it's a lot faster. So once you make your changes under the second option, if you want to update all the data tables, you have to press F9 manually to force the model to update all the data tables at the point that you want. So that's one tip. Yeah. So and let's talk about the cash flow waterfall chart. So this is the cash flow waterfall chart here. Just go back to scenario 7. Right. So this is so this cash flow water chart it's basically a stacked area chart, and it's linking through to this data here. And this data here is basically pulling out every cash outflow in your financial model, whether it's land lease payments or taxes or interest payments to the banks, repayments to the banks, or the dividends to shareholders. So for every year, you basically work out how much is paid out under each of these categories. And you can do a stacked area chart. And this gives you a snapshot of what's going on in the project. The outline of this chart is your project revenue, which makes sense because your project revenue is your FIT multiplied by your energy output. Your FIT is fixed for the next 20 years in NTD per kilowatt hour, but your output is degrading at 0.5% every year. So as you can see, your revenue is basically decreasing over the next 20 years. So that makes sense. So this is a good way to sanity check the model as well, right? So you're receiving this money. Where's the money being used on? First one is on the land leases, which is fixed. So that looks right. And then you've got operation and maintenance costs, which is a percentage of the revenue, which looks about right. And then you've got this tiny little orange sliver here, which is your G&A expenses. And then you've got your insurance, which is the red bit here. So it's a very tiny part of your cost base. And then you've got your, let's see, what else you got here? You got your panel recycling fee, which is the fee payable to TPC, which is only for the first 10 years. It's a very small cost as well. Okay, this lumpy one here, this is your replacement of inverters. So that happens in year 11, so it's a one-off cost. And then you've got the orange one, which is your interest. So you can see your interest initially is very, very high. But as you repay your loan, this is your repayment of your loan every year. So by the end of 17 years, you would have fully repaid your loan. So your interest expense and your repayment stops at the end of year 17. And you can see that interest cost is also decreasing over time as well. This is your tax liability. As you can see, because you have interest expenses, very high interest expenses to begin with, and as well as depreciation expense, the amount of taxes you pay initially is very, very low. But towards the back end, once you've fully repaid your loan and you don't have any more depreciation expense to depreciate, asset base to depreciate, then your taxes jump up. So you're paying a lot of taxes towards the back end. And the remaining cash flow, this is how much dividend you can pay to your investors. Right. So as you can see, once you've repaid your debt, suddenly there's a lot of dividends being paid out to your investors. So this is a very useful chart that I would recommend being built into every model, because it gives you a very useful snapshot of what's going on there. Which is there's a lot of stuff you can glean that from a graphical format that you can't just by staring at these numbers, right? You don't know what's going on here. Yeah. Okay. So that's cash flow waterfall. So let's have a look at the 10-year PPA extension case. What exactly is that? So this is the case number 2 here. So under the 10-year PPA extension case, so the FIT that we get with Thai Powers is only for 20 years, but the solar panels last at least 30 years, right? So there's a potential to actually extend the life of the project by signing a new power purchase agreement, whether it's with a big corporate customer like TSMC or Google or Amazon or Microsoft, who runs a lot of data centers in Taiwan and has a lot of power usage. Or we can try and negotiate another contract with TPC, right, at the end of 20 years. But the crux of it is that we should be able to extend the project by an extra 10 years. And we're assuming, for example, that we're getting a tariff from either a TSMC or a Google at 5 NT per kilowatt hour. Right, but on the flip side, we also need to extend our land lease agreement with the landowners, right? Because we only signed a 20-year land lease. So we also need to negotiate for an extra 10 years on our land lease. And on that one, we're assuming that that we're paying a 3% escalation. So at the end of 20 years, so initially for the first 20 years, we're getting our rental at 450,000 per hectare per year. But applying a 3% escalation for 20 years, it means that at the end of 20 years, we would be signing a new land lease where the rental was 812,000 instead. And this is what the resultant chart looks like, right? So this initial bid for the first 20 years, it was exactly like just now. It doesn't change. But after the first 20 years, for the back end of the 20 years, suddenly our rent steps up because we're paying more rent to account for inflation. We're still incurring all of our operating costs, and we have to replace our inverters again at year 20. But we're no longer, we've already fully paid off our debt. So there's no more debt financing to pay off, which means that we're getting a big chunk of dividends every year thereafter. And this has a meaningful impact on our equity IRR returns. Right. So this is a upside case that we're running that most developers would take a look at in terms of what's the upside in being able to extend the life of the project, because the panels will last more than 20 years. Yeah, so and this is a very compelling case for a TSMC. If we're selling our energy to them at 5 NT per kilowatt hour, it would be at year 20, because of inflation and because of rising gas prices and oil prices, the utility rates will be significantly above that. So actually 5 NT per kilowatt hour is also a very conservative assumption on our end. We could probably sell it for a lot more than that, but that's what we're assuming at the moment in an upside case. And as you can see from our IRR, yeah, there's a significant increase in our returns from doing this. So our base case right now is 11% IRR. Now, if we do this 10-year extension case, that IRR goes up to about 12.87%, and that's just from the benefit of extending the life of the project.